Dinar Shift welcomes you back to our analysis of global currency developments. Tonight, we focus on a historic shift that has been the subject of global attention for years. News is circulating from the heart of Baghdad and throughout international financial centers, all pointing to a singular monumental confirmation. After years of policy adjustments, structural reforms, and intense deliberation, the revaluation of the Iraqi Dinar, IQD, has reportedly been formally ratified and published in Iraq's official Gazette. This development, if confirmed by all official channels, represents a definitive turning point, moving the currency's status from a topic of speculation to a matter of enforceable law under Iraq's sovereign authority. This is the moment that many have monitored closely. The formal confirmation, originating directly from Iraq's highest financial and governmental bodies. The Central Bank of Iraq, CBI, acting in coordination with the Council of Ministers, is reported to have finalized and locked in a new official rate structure. The subsequent publication in Al-Waqayi al-Iraqiya, the official Gazette, serves as the legal seal, establishing the new currency valuation as binding law across the nation. This action is seen as more than just a bureaucratic step. It is the ultimate signal of a major shift in Iraq's monetary policy, resonating across the entire world of international finance. The long-anticipated news broke in the early hours in Baghdad, creating immediate ripples across major global financial platforms. The specific publication cited is Decree 74 from 2025, which formally confirms the highly expected revaluation and simultaneously outlines a completely new official exchange rate schedule. Crucially, this decree is stated to be issued under the full collective authority of the Iraqi government, granting it immediate and complete legal validity. This establishes the new currency values not just as recommendations, but as the binding and enforceable law of the land, an unprecedented move in Iraq's post-war financial history. This move is fundamentally a declaration of a major transformation in Iraq's long-term monetary sovereignty. It signifies Iraq's renewed commitment to and active integration with the broader international economic community. Reports from the Central Bank of Iraq indicate that the revaluation process was executed in collaboration with both the Ministry of Finance and key international institutions, including the International Monetary Fund, IMF. This collaborative approach was vital to ensure the entire process maintained international oversight, adhered to best practices, and achieved fiscal alignment with global standards, bolstering the credibility of the reform. A key detail of the Gazette's decree is the reported new operational exchange band for the dinar, cited as being between 1.0 and 1.95 IQD per US dollar. This range represents a monumental and extraordinary shift from the previous long-maintained pegged exchange rate. A senior policy analyst from the CBI, Fala Mahmoud, is reported to have stated during an early morning national broadcast that the decree is the direct culmination of years dedicated to structural economic reform, domestic financial stabilization, and a critical realignment of the nation's balance of payments. Mr. Mahmoud's reported comments underscore a deliberate and strategic move by the Iraqi government to transition towards a monetary policy that is not only more transparent, but also fundamentally driven by legitimate market forces. For all observers who have been tracking Iraq's white paper for economic reform, this official Gazette release provides the tangible validation that long-held policy objectives are now transforming into an operational legal reality. It is a definitive and critical milestone in Iraq's complex journey toward post-war economic resurgence and stability. The international repercussions of this major monetary revaluation reportedly began to propagate across global markets almost immediately following the Gazette's publication. Financial monitoring platforms situated in the world's major financial hubs, including London, Dubai, Frankfurt, and New York, all began to report updated exchange rate indicators. This swift response suggests that global forex, foreign exchange, systems rapidly integrated the new trading parameters issued by Iraq's authorities, a feat achieved through the Central Bank of Iraq's coordination with global clearinghouses. This near real-time reflection of the dinar's new potential value has lent the entire event an unprecedented level of international legitimacy and seriousness. Within a matter of hours, major financial institutions in the United States, including Wells Fargo, JP Morgan Chase, and Bank of America, were reported to have initiated internal testing cycles on their respective digital exchange platforms. These actions indicate tangible preparations for potentially handling customer transactions involving the newly revalued Iraqi dinar on a large scale. Analysts have long speculated that such preparations at major banks were quietly underway, but the reported internal testing provides the first concrete signs of large-scale operational readiness within the U.S. financial system. Angela Ruiz, a senior economist at Bloomberg Economics, specializing in the intricate dynamics of emerging markets, is reported to have commented that this move was a logical and unavoidable step once Iraq's vast, oil-backed foreign reserves surpassed the critical 160 billion benchmark. The achievement of this high-reserve benchmark reportedly provided the necessary confidence to global institutions like the IMF and the World Bank regarding Iraq's long-term capacity to sustain and maintain the required liquidity for a revalued currency. Ms. Ruiz described the event as an exemplary and textbook example of successful macroeconomic reform that has successfully met and secured international approval. This validates the years of disciplined, coordinated effort on the part of the Iraqi financial authorities. The reported revaluation has had a ripple effect beyond Iraq, igniting renewed speculation in other reform-focused economies, notably Vietnam and Zimbabwe. Both nations have been quietly progressing with similar monetary modernization projects, and observers now view Iraq's formalized success as a potential catalyst. The event may serve as a spark, igniting a broader, more widespread monetary realignment across numerous developing markets worldwide, demonstrating that resource-backed stability is achievable. The once purely theoretical concept of establishing currency parity within developing economies is now being tested in a real-time global environment. This marks a pivotal and psychological shift in the global monetary mindset and investor behavior, moving away from past perceptions of volatility. The clear success of a resource-rich nation like Iraq in formally adjusting its currency acts as a powerful precedent for others aspiring to similar fiscal independence and stability. The numerical magnitude of the transformation resulting from Iraq's currency revaluation is truly dramatic and consequential. Before the decree's publication, the dinar was generally traded at a market rate of approximately 1,810 IQD per US dollar, a rate that most economists agreed significantly undervalued the nation's underlying economic fundamentals. The new, reportedly ratified Gazette rate of 1.00 to 1.95 IQD per USD fundamentally alters this calculation. The appreciation represented by this significant shift is an extraordinary upward adjustment, reportedly exceeding 1,000% in value. To illustrate the impact in nominal terms, a single 25,000 dinar banknote, which previously held an international street value of less than $20 USD, could now potentially correspond to nearly its full face value when converted at international parity. This radically changes wealth calculations for both foreign currency holders and domestic Iraqi citizens. Market indicators globally began to reflect the sheer magnitude of this reported shift within hours. The price of gold reportedly dipped slightly as large amounts of speculative capital began to rotate out of precious metals and into currency portfolios, driven by the anticipation of broader similar reform trends across emerging markets. Simultaneously, the Iraqi Stock Exchange, ISX, recorded an impressive 31% surge in trading volume. The strongest activity on the ISX was observed in sectors directly poised to benefit from renewed and substantial foreign capital inflow, specifically energy, telecommunications, and banking. In parallel, the Vietnamese Dong, VND, experienced heightened trading pressure amid increasing speculation of a comparable currency revaluation on the horizon in Southeast Asia, confirming the regional contagion of confidence noted by experts. Marcus Ellington, a distinguished professor of international economics at Georgetown University, is reported to have observed that successful currency revaluations, particularly those anchored by verifiable and substantial real reserves, frequently trigger a phenomenon he calls a regional contagion of confidence. He emphasized that Iraq's policy achievement could inspire a major domino effect, prompting other emerging markets to reevaluate their own perceived undervalued currencies. Professor Ellington suggests that these countries may now pursue similar fiscal alignment and transparency, making Iraq's successful, bold policy maneuver more than just national news. It is, in effect, the opening chapter of what could become a potentially global monetary reset across a number of developing economies. The action is a demonstration that disciplined, reserve-backed policy can yield major currency adjustments. Meanwhile, in the United States, major financial institutions have entered a state of accelerated operational readiness as the full implications of Iraq's reported revaluation begin to materialize. Reports indicate that several major banks, including Chase Bank, Wells Fargo, and Bank of America, have initiated their formal currency intake module protocols within their foreign exchange divisions. This move signifies a tangible shift from purely theoretical anticipation to practical, operational execution. This protocol is typically reserved for the pre-launch verification of foreign monetary instruments and signals a deep commitment to handling the new currency. Insiders at Chase Bank reportedly disclosed that Tier 1 regional branches in key financial centers, New York, Chicago, and Dallas, have already authorized limited testing of the IQD rate integration system, ensuring it synchronizes perfectly with live data streams originating from the Central Bank of Iraq's new reference indicators. Wells Fargo, in a separate development, is reported to have confirmed the rollout of new software updates across its currency redemption network. This update now lists both the Iraqi Dinar IQD and the Vietnamese Dong VND as active under live rate visibility. This means the new rates can be continuously monitored in real time within the bank's internal systems, pending final treasury clearance for public customer transactions. Bank of America has also reportedly rolled out enhanced, high-value currency exchange security protocols, according to internal communications. These stringent new measures are designed to ensure complete traceability and compliance under crucial U.S. regulations, including the Bank Secrecy Act and FinCEN monitoring guidelines. This proactive approach ensures that all large-scale transactions are conducted with the highest degree of regulatory compliance and oversight. An internal compliance memo circulating within one major bank, as cited in reports, explicitly states that, upon verification of CBI's Gazette publication, customer transactions involving the IQD may proceed under revised oversight frameworks once Treasury confirmation is received. Analysts interpret this language as indicating that the final procedural stage is now underway before widespread public redemption can begin. Both the CBI's authorization and the U.S. banking system's readiness appear to be converging. The only remaining expected component is the formal Federal Reserve Clearance Memorandum. This document is anticipated to fully formalize U.S. exchange participation, thereby opening the channels for verified, regulated transactions at all major financial institutions. This development would mark the final step in integrating the new IQD rate into the global financial plumbing. Within Iraq itself, the economic and psychological impact unleashed by this reported revaluation decree is monumental. For the first time in over 2 decades, the Iraqi dinar is reportedly on a path to reclaiming its global standing as well as its essential domestic purchasing power. Since 2003, the nation's monetary identity has been persistently hampered by instability, discrepancies with the black market, and an over-reliance on the U.S. dollar for trade settlements. The Gazette's Decree 74, 2025, is intended to reverse this long-standing narrative, setting a clear foundation for true economic sovereignty. The Central Bank of Iraq's outlined objectives for the new framework include strengthening citizen confidence in the dinar, greatly expanding access to foreign reserves, and eliminating the long-standing parallel market distortions that plagued the economy. These measures directly address fiscal vulnerabilities that have severely hindered the private sector and constrained consumer growth for years. Government spokespersons are reported to have stated that Iraq has definitively achieved economic sovereignty. They emphasize that Iraqi citizens will now see the direct benefits through necessary wage reforms, greater import stability, and a renewed sense of national pride and control. Economists widely predict that the resulting stabilization of consumer prices will gradually and inevitably erode demand for informal exchange channels, effectively neutralizing the underground currency market entirely. With greater transparency and a much more predictable, higher valuation, foreign investors are expected to rapidly accelerate their flow of capital into key Iraqi industries, including energy, logistics, and telecommunications. Early data is already suggesting a renewed and vigorous interest from regional investment funds based in major Gulf nations like the UAE and Saudi Arabia. For the average Iraqi citizen, this reform is more than just financial policy. It is a profound symbol of restored dignity and the potential dawn of sustainable prosperity. The shockwaves from Iraq's dramatic currency revaluation have extended well beyond the Middle East, reaching the finance ministries in Hanoi, Vietnam, and Harare, Zimbabwe. Policymakers in these locations have reportedly been quietly preparing for a similar moment. Historically, major decisive moves by the Iraqi dinar tend to draw the Vietnamese Dong, VND, and the Zimbabwean dollar, ZWL, into similar trajectories, largely due to their parallel economic reform agendas. In Vietnam, the Ministry of Planning and Investment has reportedly spent the last 2 years building the technical groundwork for a gradual transition to a more free-floating exchange system. This initiative is intrinsically tied to the modernization of the nation's banking infrastructure and the digitization of payment settlements through the State Bank of Vietnam. With Iraq's success formalized in the official Gazette, Vietnamese policymakers are now expected to significantly accelerate their own timeline for unveiling a revised currency framework. Meanwhile, Zimbabwe has pursued a distinct yet complementary strategy, choosing to leverage its substantial reserves of tangible assets, particularly gold and lithium, to anchor significant portions of its national currency. This strategy is designed to better insulate the currency from the volatility of inflationary shocks and speculative trading. Economists are increasingly referring to this unfolding dynamic as the Tri-Currency Reform Corridor. This corridor represents a cooperative and parallel movement among Iraq, Vietnam, and Zimbabwe, all seeking to restore global trust in their sovereign currencies by tethering value to tangible assets rather than relying solely on debt instruments. IMF researcher Sarah Donovan aptly summarized this burgeoning global trend, reportedly declaring, "This is the dawn of an asset-anchored era." For economists and those who have followed the investment story, Iraq's official confirmation transforms what was once dismissed as speculation into a credible, operational precedent. Across global economic circles, a chorus of expert voices has emerged to analyze the wide-ranging implications of Iraq's reported monetary breakthrough. Professor Marcus Ellington is quoted as stating that the Iraqi dinar's revaluation demonstrates how highly disciplined monetary policy can effectively transform perception into quantifiable power, emphasizing that credibility, not pure speculation, is what truly drives sustainable currency value. This sentiment is strongly echoed by Angela Ruiz of Bloomberg Economics, who reportedly reinforced that this event is not a speculative bubble, but a state-driven fundamental recalibration. She notes that it is solidly supported by verifiable oil revenues, substantial sovereign reserves, and a deep-rooted systemic fiscal reform effort. These perspectives reflect a growing international consensus that Iraq's action is not an isolated experiment, but a deliberate and well-planned realignment within the broader, established international financial architecture. Charles H. Monroe, an IMF consultant with experience advising post-conflict economies, is reported to have added that Iraq's success proves a developing nation can achieve currency parity once structural corruption is effectively addressed, and national reserves are robustly protected. He points specifically to the transparency reforms within the CBI as a potential model for other emerging economies to emulate in their own pursuit of stability and independence. Furthermore, insider reports from the IMF's Basel Coordination Office indicate that live interbank systems are actively preparing to display Iraq's revised IQD rates as early as the next business week. This confirms a full integration into the SWIFT-linked international payment framework, signaling a major step toward global acceptance. This is complemented by U.S. currency redemption centers beginning to receive updated compliance directives and security protocols. Collectively, these operational developments reinforce the perception that the global financial infrastructure has already begun the process of adapting to a post-revaluation reality. This new world is one in which sovereign wealth, tangible reserves, and disciplined governance are re-emerging as the primary factors that define a currency's strength, holding more sway than transient speculative market forces ever could. For those who have held a position in the Iraqi dinar, Vietnamese Dong or Zimbabwean Zim notes, this moment represents both a major validation of their long-term perspective and a call for responsible action. While the recent confirmations and banking alignment strongly suggest that the revaluation mechanisms are moving from the realm of speculation into tangible operational implementation, preparation remains absolutely critical for all holders of these instruments. Financial experts and compliance advisors uniformly stress that this period is not one for impulsive, rushed actions, but rather for disciplined readiness and informed decision-making. The first essential step for any currency holder involves securing all supporting documentation, original currency purchase receipts, detailed transaction logs, and valid current identification records. These materials are essential for the verification process when presenting currency for redemption at recognized financial institutions. Secondly, experts strongly advise the crucial step of verifying the authenticity of any bank branch or redemption center used, ensuring all transactions are processed through federally insured or officially designated facilities. Thirdly, it is imperative that currency holders consult with qualified tax professionals to navigate the complex issues of capital gains and post-exchange obligations. Sudden liquidity events can trigger significant fiscal consequences under both national and state tax regulations. Diversification remains a key financial principle even at this stage. Analysts recommend that any post-revaluation gains should be strategically spread across multiple asset classes, such as diversified equities, commodities, and real estate, rather than concentrating all proceeds within a single currency or financial institution. This protects the gains and ensures long-term wealth preservation and growth. Finally, remaining meticulously informed through legitimate, verifiable channels, including the Iraqi official Gazette, the Central Bank of Iraq (CBI) official statements, and recognized financial publications will be crucial. This vigilance will help all holders to effectively separate verified factual developments from the inevitable swirl of market rumors and unsubstantiated claims. Those who approach this new stage with calm, patience, and strategic awareness will be best positioned to capitalize on this unfolding new era of asset-backed stability across global markets. Globally, media outlets and financial think tanks are responding with intense attention to Iraq's landmark currency revaluation, recognizing it as a watershed moment in the history of post-conflict economics. Major international networks, including CNBC, Bloomberg, Reuters, and Al Jazeera, have pivoted their coverage to focus on Iraq's unprecedented ascent from a fragmented financial system to a model of structured national reform. The common message emerging from global headlines is that this revaluation represents not just a minor currency adjustment, but a fundamental transformation in Iraq's geopolitical and fiscal posture. The World Bank's Economic Stability Division reportedly described the move as a cornerstone of post-conflict reconstruction economics, underscoring how Iraq's strict adherence to monetary discipline can serve as an inspiring and successful path for other developing nations seeking stability. Simultaneously, the Gulf Cooperation Council, GCC, has begun formal consultations aimed at swiftly integrating Iraq's new dinar parity into their regional digital payment networks. This initiative, if successful, would substantially strengthen cross-border trade and significantly reduce the region's overall reliance on external clearinghouses for trade settlement, furthering regional economic integration. In Washington, D.C., U.S. Treasury officials have reportedly publicly acknowledged Iraq's substantial progress and full compliance with global anti-money laundering and counter-terrorism financing frameworks. This action effectively removes one of the last major administrative barriers to Iraq's full and active reintegration into the SWIFT global financial network. The removal of this barrier is a powerful endorsement of Iraq's governance and transparency efforts. Market strategist Robert Hayes is quoted as capturing the prevailing sentiment concisely, stating, "This isn't just Iraq's victory. It's a blueprint for every developing nation seeking monetary independence and economic dignity." The symbolic weight of this confirmation is undeniable. For decades, the dinar was synonymous with financial fragility. Today, it reportedly embodies reform, renewal, and the triumph of disciplined, strategic policy over past chaos and instability. Iraq has effectively redefined what recovery looks like on the global stage, achieving it not through market speculation but through rigorous strategic execution and unwavering economic resolve. The next phase of Iraq's economic journey is already taking shape, with analysts across various institutions aligning their forecasts around a notably optimistic trajectory. Over the coming 12 to 18 months, Iraq's gross domestic product, GDP, is projected to expand significantly, reportedly by an estimated 8.3% annually. This projected growth is anticipated to be driven primarily by the dual engines of confirmed monetary stability and the productive reinvestment of its substantial oil revenues. The newly strengthened Iraqi dinar is expected to cut the cost of imports significantly, which will allow local industries to reinvest their savings into modernizing key sectors like manufacturing, agriculture, and services. This influx of capital and stability will be key to long-term diversification. Analysts further anticipate that the enhanced purchasing power will not only significantly improve domestic consumer welfare for the Iraqi population, but also attract more than $40 billion in foreign direct investment, FDI. This capital is expected to flow specifically into critical Iraqi infrastructure and digital connectivity projects. International consortiums from the European Union, the GCC, and East Asia are already positioning themselves to participate in major public-private ventures. These ventures are intended to fully modernize Iraq's ports, power grids and transportation corridors, transforming the nation from being merely an oil-dependent exporter into a diversified, regional hub for logistics and renewable energy. For the global financial community, this revaluation stands as powerful proof that long-term reform, transparency, and fiscal discipline can successfully convert years of financial volatility into sustainable national prosperity. The dinar's widely reported ascent serves as a powerful reminder that a patient, well-articulated strategy grounded in strong economic fundamentals eventually triumphs over persistent uncertainty. This is not seen as the conclusion of a long-held hope, but rather the definite beginning of a new economic era. The global map of value creation is visibly being redrawn, and those who approach the situation with wisdom and knowledge will help shape its contours for decades to come. Thank you for tuning into Dinar Shift, your source for balanced analysis and educational insight into global currency reform stories. We encourage all viewers to consult licensed financial professionals before making any investment or currency decisions, as the content provided is strictly for informational and educational purposes. Exchange rates, timelines, and policy references are always subject to official confirmation from recognized governmental or financial authorities.